We are excited to transition now to the Energy Finance panel. This session will be moderated by Alicia Seiger, who will be joined by Abdi Martin and Mark Roston. So Alicia is the Managing Director of the Sustainable Finance Initiative at the Freeport, with extensive experience in advising government, including governors of California and New York, pension funds, and investors on climate risk and resilience. Alicia is at the forefront of sustainability and energy finance initiatives.
Thank you for that warm introduction, and Bianca and the whole team for pulling this. You guys are so lucky to have this. When I was in your shoes, there was no such program. So enjoy. We are gonna cover three primary things today, and hopefully maybe more as the Q&A unfolds. But those three are sort of wayfinding exercise. I think with orientation that's sort of helpful for you all, and you can have some cards if it is. Who are we? I mean, you heard a little bit about my bio, but how did we get here, and what does that mean for you as you think about what to do with your Stanford career and beyond? An orientation of what is the Sustainable Finance Initiative and what do I do with it? And then we're also going to get into some substance of our work to understand how it intersects across the different areas of curricular pursuits that we engaged in at Stanford. So just quick show of hands. I know the rough numbers, but how many of you are in the engineering track? Okay. Great. Business. Okay. And law or other policy, other humanities. Okay, so we're heavy on the tech side. So that's great. And I hope you will find, and after this conversation, a deeper understanding of the ways in which finance and humanities or social sciences broadly are the oxygen around which technology will thrive or not thrive, and what is required for its eventual success. So with that, let's just start with our wayfinding conversation. So Abby, I'm going to start with you. Did you literally arrive in the seat today? What brought you? I mean, tell us about your.
I drove in a car from Oakland, literally. But I came to SFI. I'm a pretty new addition to the team. Mark and Alicia and Tom here, and I see Julian just walked in. Have been working together for many years, a lot of different exciting topics. But I'm relatively new. I'm coming from most recently the UK, where I've been on the research faculty at University of Sussex Science Policy Research Unit. And prior to that, I did my doctorate at UC Berkeley, and I've had a couple stints at other universities as visiting faculty at Berkeley and in Norway as well. And at sort of my trajectory to those places really, I think, started after undergrad. I was considering going to law school. I thought that was just the obvious thing to do, being a sociology and environmental science double major. And then when I started looking at law programs, I ultimately found that the questions and issues that I was interested in seemed like things I wouldn't actually get to work on coming out of law school, working in a big firm, potentially, or even, for the government. So I took a turn and had a couple of years working for a global consulting firm doing sustainability reporting. And this was like early days in the aughts, where there was sort of some basic agreement on what indicators and metrics a company needed to report, but companies already had sort of these bigger questions about, how can we do this in a way that's actually meaningful to us, and what kinds of issues beyond just measuring and monitoring we really need to think about with regard to innovation and what we do in our R&D departments. And so I started working in consulting in a lot of sort of big Fortune 500 companies. And the most interesting client client group that we had come into our practice was a group of researchers that were working at the Mickey Leland EPA Air Toxics Institute in Houston, Texas. And this group was focused on bringing oil industry, mostly toxicologists that are employed at big oil companies, together with environmental justice groups in Houston. So residents that are living right on the front line of the biggest oil refineries in the country, and trying to figure out what Houston could do as an entity that regulates its air to make the air healthier for the groups that are sort of hardest hit by those industries. And that was just really inspiring for me and sort of pushed me to look into graduate school elsewhere. And I went and did my PhD at Berkeley in environmental science, policy and management. I really wanted to do something interdisciplinary. I spent a lot of time focusing on economic sociology and economic geography, as well as something called science and technology studies, which is a really interesting field. There's sort of a group of scholars here at Stanford that are great in this area as well. And the focus there is really looking at how a lot of policy decisions, a lot of big visions of how we think about technological change come in sort of closed door meetings and spaces where we tend to not think about politics and certainly not democratic politics as you know, being present. And so from there, I went and have since been studying various sort of transition cases. I started looking at biofuels for my dissertation, looking at how it came to be that the US and Brazil have just been pouring tons of money from the top down into major transition in liquid fuels and what the outcomes have been, and have gone on to look at other energy technologies as well. And the general approach that I'm sort of trained in from Berkeley and that I continue to use is combining that top-down perspective on what are these grand sort of technological visions that scientists and presidents come up with, and what happens when those visions hit the ground in terms of the groups that actually have to implement them, whether they're farmers, whether they're labor unions and workers, whether they're communities that are sort of mobilizing on the front lines, like those environmental justice groups in Houston. And so what I do as a researcher is to continue to try to sort of understand how those two levels sort of meet and really shape how transition unfolds around our climate policy.
Great. And I'm going to offer a little editorial and color commentary before we turn to you, Mark. So I should have said at the outset that both Abby and Mark are researchers at the Sustainable Finance Initiative, and they have their sort of lanes and archetypes. So again, as you're thinking about this as a wayfinding exercise, not to put you in a particular lane, but in terms of your curiosities, Abby is someone who has journeyed through PhD, through academic kind of pathways and pursuits, and in the policy and political economy conversation. So that's sort of one pathway into this work. Mark is going to be a very different archetype here. You're PhD, but in this finance world. And then I'll say a little bit more about my story, but more of the entrepreneur. But again, all in this kind of social sciences intersections with innovations and service and climate. So, Mark, tell us your archetype and how you, your way, the breadcrumbs you could leave in your wayfinding journey.
Nice to see you all. Happy to be here. I'm like a cliche of an economist. I finished a PhD in economics at the University of Chicago in the mid-90s. Did not go an academic route. I went into finance. I started my career managing quantitative long-short equity. Did that for a number of years at a big bank. And moved to a very large consulting firm that has a secret investment operation where I did a lot of their secret investing. It used to be secret. It's no longer secret. And then let's see. Then I went to a firm where I did that was mostly hedge fund type investing at the consulting firm. I then went to a big alternative investment firm where I led the investment team and investing in hedge fund strategies and various parts of financial services, private equity, primarily in insurance, banking, and what I only half jokingly call white collar loan sharking. Today we call that private credit. Is the way to describe that. Then I joined SFI a little over 4 years ago because oddly, a friend of Alicia's knew a friend of mine, and Alicia was looking for someone to look at applying some innovative thinking to how institutional investors think about climate finance. My dissertation research and all of my thinking around investment decisions was driven by the fact that people respond to incentives. People do what you pay them to do. And so that very much sort of describes my view of what goes on in climate finance. It's understanding incentives people face, how they will respond to those incentives, and how you align incentives correctly to get the outcomes you want. In the context of climate, I think roughly speaking, I would sum this up as we need to internalize the externality of climate damage. And so as we'll get into, much of my work around what SFI does is about how do we, in a formal and technical sense, internalize the externalities of climate change.
Great. And I'll just briefly, again, to round out the wayfinding and the archetype. So I'm more of the entrepreneur and the MBA of these three lanes. So I actually, as an undergrad, started with the entrepreneurial spirit, designed my own curriculum that was focused on combining environmental science and policy, cultural anthropology, and looking at this question of how to find harmony between human and natural systems, which then evolved into businesses and the environment, and then evolved to capital markets and climate, understanding the paths to harmonization and the innovations that could result in that. I did my MBA here at the GSB and graduated a long time ago now. And stayed on for 2 years writing case studies at the Center for Entrepreneurial Studies, which was a wonderful experience to learn from an incredible array of mentors, and but also gave me this exposure to the pedagogy of the MBA curriculum, and to a future eventually coming back to Stanford after building a couple of entrepreneurial ventures of my own in the first web advertising space and then in the carbon offsetting space, to come back to Stanford, where these centers and initiatives are kind of they're entrepreneurial platforms of sorts. So the way I think about SFI and the Steyr Taylor Center for Energy Policy and Finance, which this year is actually the first year I will stop using that in our title. It was set up as a term endowment at the same time as the Tomcat Center, but it is now sunsetted, and kind of it can be thought of it. All that work and the research agenda and the people are all inside of the Sustainable Finance Initiative. So it has kind of merged into this one thing. But these are, entrepreneurial platforms to develop and deploy climate solutions, leveraging the assets of the university, which include you all as students, but also alumni and faculty and fellows and research and postdocs, and the assets of the university. And so that's really what we're doing here at SFI. And our mission is to develop the innovative policies and financial mechanisms that can drive towards effective and efficient decarbonization of the global economy. Small ask. But that comes in many different forms in terms of our output. What do we actually do? We do research, analysis, we publish papers, we convene workshops, we bring students into our band of Merry Pranksters and have everything from one-on-one advisory of how to think about these issues in the context of the questions you're asking, to what should I do for a summer, what should I do for my life, what should I do in between, to we have research associates or analysts or TAs for our classes where we're bringing in, these are all the different on-ramps for students to interact with SFI. As you've probably discovered now through your orientation, there is no building that's like, oh, I will go to SFI. It is, we're inside of the Precourt Energy Institute, which is inside of the Door School, but these are not, again, physical places, just organizational design. But I would encourage you, as you're going through this orientation process, to find your people, to find the people that spark ideas for you or that have experience or information that you're curious about. And it's really in all these different centers, initiatives, institutes, it's the people and the kinds of conversations and connections that they're having and making that may be catalytic for you as you go through your Stanford journey. So I think that's kind of as much about SFI as, though I'll make a couple plugs. We do have in the fall a seminar series where every month we bring in a speaker. They are, for the most part, virtual, and they are recorded. So you can zoom in or you can watch them on our website. You can go to our website and look at all the past seminars, which are quite interesting. We have all of our publications there too. And then we have different, over the course of the year, different curricular offerings, whether they're policy practicum or classes at the law school primarily, although there may be some door school classes coming soon, but that's where folks affiliated with the initiative are teaching classes in and around this content. So that is who we are and what we do. There are more of us. Julian, I see you want to raise your hand. So Julian, Mary came out of a master's program in economics, was a fellow with us for 2 years and is now matriculating. So you're not even here to support us. You're here because you're actually here as the energy. Yeah, you're actually, yeah. So he's now starting a PhD program in MS. So we have probably about a half a dozen people who are tightly affiliated with us, and then another dozen that are loosely dotted line affiliated with the initiative. We're always trying to make as many connections because climate is everything. It's all the disciplines. And certainly once you're in the social sciences, the intersections of the work across the GSB and other parts of the humanities departments are very instrumental in contributing to the policy and financial innovations that we're talking about. So what are we talking about? I'm going to do another poll. How many of you have heard of net zero? Okay, how many of you think folks who have signed up, companies and countries who have signed up to a net zero pledge have any idea or ability to actually get there? You're starting ahead, so you already know the problem here. That is one of the problems we are trying to solve. And I'll just do a quick plug for a sleep aid / a book that is aged like a fine wine that our team published in the fall of 21. It's called Settling Climate Accounts, Navigating the Road to Net Zero. And this was kind of a COVID project for us all as we were in our homes trying to build community. And we started to talk more about our individual research projects and started to see a real pattern emerging that was a giant diagnostic, essentially, of all the ways in which net zero was going to struggle to add up. And this book was an account of climate action in the triple sense of the word. It was a storytelling exercise of understanding how did we get here, where net zero is the dominant organizing principle. What was the last 3 decades of climate action? What has happened there that led us to this moment, which is really important to understand so that we don't repeat it. And then a technical investigation of accounting is, in the technology of making, adding up the books. And then account is the root of accountability. How are we going to make this all add up? And the book concludes by identifying 4 unsettled accounts that are going to continue to plague voluntary climate action as we move forward. We'll get into them in more detail, but they're data, boundaries, timing, and obligation. I'm going to spare you the book talk, but maybe you all can touch on those unsettled accounts as we get into the substance of our work. If that book was a giant diagnostic of all the ways in which net zero will struggle to add up, the work that we are doing now is the solution set. And it looks like carbon accounting and accountability, which drives efficient and effective carbon markets. It drives real transition finance. It drives massive investment in decarbonization, which are, I presume, of the 70% of you who raise your hands on the engineering side. It gets them the incentives aligned to invest in the technologies that you are imagining and manifesting. And it is the foundation on which net zero can add up. It is also a foundation on which we can conceive of and actually make some progress on adaptation and resilience. So that's the body of work we're engaged in now. And I'm going to turn to our brain trust here to unpack some of that. What do I actually mean by it? So Mark, what is carbon accounting and how is it different than what the current practice of net zero looks like?
I know you were all thrilled here to talk about accounting.
Yeah,
that's
just fell
why
asleep.
you came to grad school to hear talk about accounting. So here we go. Carbon accounting is about allocating and attributing carbon emissions, the greenhouse gas emissions, to those responsible for the emissions. And I'm sure some of you have some experience with this in hearing mostly about the greenhouse gas protocol. And what I will say is, we're not big fans of the greenhouse gas protocol. One of the
Easy there.
easy there. One of the challenges of an accounting system is that it needs to be mutually exclusive and comprehensively exhaustive. And what that means is we have to count all the emissions and we have to count them once, and we have to allocate them to the parties responsible. If you want a really fun homework assignment, Alicia laughs when I tell people this. You should go and watch the South Park episode called "Something Walmart This Way Comes." This is everything you need to know about about carbon accounting. Is who's responsible for what the outcomes are, and it's about incentives. So enjoy that homework assignment. But what we're trying to do is say we're going to use standard accounting techniques to figure out the way to attribute responsibility for emissions. And what this means is we're using good old-fashioned cost accounting. So cost accounting says that when you make products and you allocate your corporate costs to those products, and you can sort of accumulate the costs through a manufacturing process or a service delivery process, so that you know what costs of your corporate overhead get allocated to which products. We're just trying to do a very similar thing in carbon accounting so that we can look at the economy and say, you know, how much carbon went into constructing my phone? And this is not as simple as saying, well, how much carbon went into making the glass? How much carbon went into making the chips? It's how much carbon went into making the semi-fab that spits out the chips? And how do we allocate the emissions from building the TSMC factory to the individual chips that Samsung put in their phone? And what our work does is try to align the sort of standard practice of accounting to the complex and fraught discussion of attributing responsibility for climate change. And that's a very hard and complicated problem, but it's an essential step before we can start saying, let's hold Samsung accountable for how much carbon went into my phone. Yes, I am the only person at Stanford who has a Samsung phone. Yeah, I think so. So I don't live here though, so that's my excuse. So what our.
Can I interrupt you for a
Yeah.
second? So I want to come back to accountability with Abby in a minute, but before we get there, you just essentially defined the liability side of it.
Yep.
And I steer you into the asset side of
Yep.
the ledger, which gets to accountability, which also gets to carbon markets, which also gets to all the technologies that's getting in.
Okay, so our conception of how we're dealing with carbon accounting is to say carbon emissions are a liability. Carbon, CO2 goes into the atmosphere and it's going to be there for a very long time. And that should be the liability of the emitter. The only way to, in a fancy word, is defease liability. So the only way to absolve yourself of the actual sin of that liability is to remove a ton of carbon from the atmosphere. And there's where the question becomes, what are assets under the carbon account? And in our conception of this framework for dealing with atmospheric CO2 or other greenhouse gases, is that carbon removals that are truly permanent, or at least as long as the CO2 would have been in the atmosphere, you have to remove it from the atmosphere. So, for example, I'm sure you've all seen many a Guardian story that says such and such a project that said it was carbon removals that were going to be permanent went up in smoke. And carbon markets are terrible. We're trying to solve that problem. The way we're trying to solve that problem is simply by saying, just like in any other financial market situation, when you buy a ton of carbon that has been removed from the atmosphere, you have an asset on a balance sheet, a carbon balance sheet, and your assets must exceed your liabilities. So a company, and so one of the things we do here, Alicia asked, does anyone understand what, have any of these companies that have made net zero pledges, do we know what they're doing? You're not alone. No one knows what they're doing because none of them will actually even define what net zero means. And so one of the things we've done with our carbon accounting work is given a very strict definition of what net zero means. It means if I emit a ton of carbon into the atmosphere, I remove a ton of carbon from the atmosphere. It's as simple as that. And so a lot of our work lately is about how do we describe and define carbon removal assets so that they can be traded like anything else that trades in the world. So
I'm gonna interrupt you again, just sorry, I do it with love and trying to keep everyone's attention. So what you just defined is really important. I hope you guys all little note there. I mean, what is net zero? Net zero is, you emit a ton, you remove a ton, but also keep in mind that climate change is a stock problem, not just a flow problem. So we've got a duration issue that you have to keep that removal over the duration of the liability. That gets into carbon removal and all the technologies in carbon removal and their various states of readiness and scalability and MRV, which are all the questions, by the way, that we are also asking. And there's another question here that's probably on your minds is, well, what about the low carbon cement and steel? And what about the avoided emissions? How do those play into this accounting framework, Mark?
excellent question. So the whole goal here is to say, we have to match we have to match actual emissions with actual removals. And the challenge with avoided emissions is that they are, I'll say, dicey counterfactuals. And so what our approach does is it simply says, you can't trade avoided emissions. There is essentially no functioning market in the world that allows you to trade liabilities. So what we say is that if that greenhouse gas emissions create liabilities, the economic value to not emitting emissions, not emitting greenhouse gases, is that you don't have to pay the expense of removals. So rather than saying, hey, Abby, I'm going to pay you not to drive home tonight, so you can not have your, she has an electric.
There's still a case of it, yeah.
So, rather than saying we're going to pay people to avoid their emissions, and that really screws up attribution, because if I pay Abby not to emit, and Abby's not emitting, but I'm claiming credit for the fact that she's not emitting. What we do is we say, look, if you avoid emissions, then you are not creating a liability that you are required to meet the fees. And so as long as it is cheaper for me to push emissions out of my supply chain or push emissions out of my production process, then I will do that. Removals are very expensive. So all of you who are thinking about working in, technology for carbon capture, all of these technologies are extremely expensive right now. So in fact, what you would all benefit from extraordinarily is people being forced to buy those things every time they emit. But until we figure out a way to structure these markets that can incentivize people to buy carbon removals at reasonably high prices, nobody's going to buy the products you want to make. So a core part of what we're trying to do is describe the market microstructure and build market infrastructure that will allow for carbon removal trading to succeed, and these carbon removal companies to actually be able to sell product. Because right now, if we sort of say, fine, direct air capture and mineralization is pretty darn expensive. It's, call it $500 a ton right now, if you can get your hands on any of it. But as long as the market is saying the current carbon accounting and accountability regimes are saying you are basically indifferent between avoiding a ton of emissions, which is a very cheap thing to do, call it $1 a ton, versus removing a ton from the atmosphere permanently, you're never going to compete with the carbon removal technologies.
Okay, I'm gonna interrupt you again. We'll get to questions in a minute. I'm gonna finish our narrative here. So I hope those of you in the room who are on the technology side, some light bulbs just went off of, oh, here's how we get the pull, how we align incentives for pay for these technologies that otherwise don't have markets. The business side, obviously, the implications of this are profound and pervasive across anything you're thinking about doing in climate. But the message I hope to just leave you all with here is like, after the initial boredom of hearing the word accounting, like I recognize accounting is the foundation on which all of climate action can move forward, and we don't have it right now. We have counting, got the A and the extra C. So we're just falling through the cracks of the sandcastle or the house of cards of the foundation that we're on, because it's not fit to purpose or built to withstand the kind of pressures of the massive scale up from billions to trillions and of a move from voluntary to mandatory sets of activities. There are implications for trade. There are implications for the accountability and evaluation of our tax subsidies and credits in this country. There's and then there's the global carbon markets, which are on their like fifth epic, the roller coaster just continues of multiple decades of trial and tribulation of the carbon markets. So I hope that is impressed upon you, but this has also so far been a conversation about mitigation, which, as we know, we're not winning the battle enough to not turn our attention also to adaptation and resilience. So I want it, when the 10 minutes before we turn to questions, and you get to go first, how does this work, Abby's? Oh, and I want to say one other thing before I. Let me also say that, we don't just write papers and talk about it and marvel at our own good ideas. There's an implementation pathway to all the work that we do. So we are working in partnership with governments and companies to develop ideas, test them, pilot them, and to build implementation pathways. These conversations and fora are not just in the US, they are global and different jurisdictions where there's opportunity and leverage to actually design and implement these conversations. So a little more just again about what SFI does and how it does it. But I want to turn it back to you, Abby. How does this conversation, and particularly with the intersection of accountability, branch out into the really necessary and critical questions around adaptation?
In some ways, they're sort of separate streams within the sort of climate policy and climate governance world that are now finally starting to intersect a little bit more in terms of the actual resources and regimes that are evolving. I guess first, before I comment on that, I want to just comment on some of the things that Mark said, because it made me wonder, there's so many engineers or people that are going in engineering programs in the room. Can we see a show of hands of people that have know about life cycle assessment or worked or done like LCAs before, even just know what it is generally as a concept? So I think it's helpful just to sort of link that to the work that SFI does, because that's something that's a little bit more well known. And if you think about the kind of framework that Mark and Alicia have been describing as sort of a toolbox, a different way of thinking about how we do carbon accounting. Within that toolbox is a need for a lot of other tools that don't exist. And that's what a lot of the work at SFI is about, is figuring out how to actually create those tools and implement them in markets. And the kinds of problems that Mark was describing in the voluntary carbon market look a little bit different when we move over to compliance markets. And there, for example, whether it's for, mandates for buying, X billions of gallons of biofuels in the US, or as Europe has, or mandates around purchasing, government mandates around purchasing low carbon steel or low carbon cement, which a lot of people are advocating for, but don't quite exist. The current tools we have to even know what counts as low carbon are not great. And biofuels is kind of the first case study that we have of when LCAs get taken up by policy actors and used by governments to actually decide, how do we know whether this is a low carbon biofuel versus just a biofuel that might actually be contributing to more emissions, for example, if it results in indirect land use, deforestation somewhere else because it's shifted agricultural markets around. And what's so interesting about that case is it really shines a light on how limited we are in terms of how we can know exactly where emissions are happening. And some of the work that SFI is doing is looking at that problem taken up in the removal space, which is what are the monitoring tools? What are the technologies that we have to actually be able to look at chemical changes within the environment to understand how carbon is being released or stored? And then how do those technologies get taken up within the kinds of standard systems that you need that define like, okay, this is what a low carbon biofuel is. This is what a low carbon cement product is. This is what low carbon steel is. How do we actually define those standard system in a way that is accountable to the climate goals that we want to see realized? It all sort of makes logical sense when you lay it out, you know, but the devil's always in the details. And a lot of the problems that we find ourselves spinning around is just the absolute difficulty it is to know how carbon is acting in the environment and then to act with a lack of certainty in the marketplace, whether that marketplace is set up by government actors or whether it's purely market actors and voluntary. These are really complicated problems. And as engineers or MBA students, these are sort of, I think, the key things you'll start to bump up against if you're interested in climate and figuring out sort of how to make an impact within the respective sectors or technologies that you really care about is sort of what kinds of institutions and parameters need to be in place in order for these technologies really to scale and to scale in a way that delivers reductions in greenhouse gases, but also so getting back to the question you posed, also contributes to other types of desirable outcomes that we would like to see beyond just a technology going from like, you know, a readiness level of 1 up to 7 and getting out the door and being fully commercialized. When we expand outside of just that, is this technology going to be deployable and scalable? Once it hits the ground, all sorts of other questions start emerging. So for example, when we think about how the electricity sector has changed so much over the last 2 decades, but especially the last decade as we have more renewables coming online, we've done a lot in many ways in terms of reducing emissions within the electricity sector. But now we're seeing that some of the chosen technologies and the chosen strategies that we've looked to help us bring down carbon are not necessarily the best ones for communities that might be vulnerable in certain types of disaster situations or communities that are especially vulnerable to high levels of public health impacts when we have incidents, heat waves, things like that. So these technologies are not just sort of interesting for your purposes from the point of view of how do we get them into the marketplace, but then also what happens when they start to hit the ground and really become either part of a solution or in some cases contribute to undesirable consequences or need to perhaps be rethought around a rapidly changing environment where we're all sort of feeling some places more than others, dealing with an environment that looks different, radically different from year to year and will increasingly becomes. So,
great. I want to make sure we have time for questions. So that's in it. You know, we ended 2:20, right? Okay, so let's turn it over. I want to turn the gentleman here who I have this really.
Thank you so much for the super insightful sessions. My question was more around if you had to in some ways color where in the value chain, right? Do the biggest gaps exist today? Is it on the tracking side of not having a robust protocol and accounting standard, which doesn't appropriately capture most of carbon emissions, or it's on the infrastructure and market linkage side, in terms of it, there not existing a robust infrastructure for firms to be able to adequately trade and remove the carbon. So is it because there's a GAG protocol that's not adequate enough for?
So it's a complicated question to try to, I suppose, allocate the blame. That there are problems that have to be solved jointly. They are the same problem. So for example, this may make sense to some of you, it may not make sense to any of you. But imagine that you're trying to trade something in a financial market that hasn't been correctly defined. It just doesn't matter. Like, you can trade it all day long, no one knows what they're buying and selling. And so there is so much variation in both the accounting and the microstructure of what gets traded, that invariably, like, all of these markets crash on the rocks eventually. We've seen a number of cases where that's happened quite recently. But really it's a problem. They're tightly linked together. So when we need to trade something, we have to understand what it is, how much of it is there, who owns it, how you transact it, and how you keep track of it. This is like the ugly plumbing of financial markets. And carbon markets have never had their plumbing sort of tested or designed. And that's really what we're trying to do.
Other questions? Yeah, I'll go here in the back and then I'll come. Yeah.
Do you think there should be a geographic component to the definition of net zero that you have put out? Because say, for example, you're a large company like Google, you have a carbon liability, you're powering a data center in Texas, for example, and then you purchase a carbon asset, maybe you're funding reforestation in Brazil. There's a massive geographic difference there. And I've heard the argument that this sort of, do good for the climate anywhere isn't necessarily the best approach, because it doesn't solve the fact that, your liability is still somewhere else.
Great. You know what I'm gonna do? I'm gonna batch because there were a number we can do and I'll put discipline on. So let me take two more questions right here and right there. And then, yeah, go ahead.
I have a question about implementation, because I think current policies are more around incentives and grants. So it seems like we're still pretty far away from having a mandatory carbon tax or credit in place. What should the companies do during this period of time?
Yeah, great. Okay, and one more in the back, and then we'll do another batch, but go ahead.
So I did the homework and read the papers that were pushed out. I encourage everyone to read
You
it.
get a gold star.
So my question is, why are we being intentionally exclusionary towards efficiency improvements and carbon avoidance projects? Reason I ask is because fundamentally, what essentially is lowering your liabilities, and what you're trading is not necessarily the liability itself, it's trading the fact that you can cause a change in that liability. Similar to how in the IRA, certain tax credits are tradable in the existing markets. So if fundamentally a ton of carbon avoided is still a ton of carbon anyway, and the planet doesn't really care how you save that ton of carbon, why are we designing a market and setting up accounting standards to intentionally put it out?
Okay, so the third question almost answered the first question. So the first question was sort of 24/7 location based part of it. Second was pricing and incentives, and third is efficiency and avoidance.
Okay,
That's all you, Mark.
all right.
And quickly, because I want to do another batch.
I'm watching the clock. Okay, so geography. Geography, the reason it doesn't matter is because the greenhouse gases don't care about geography. The distinction that's very important is, are we talking about removals, or are we talking about trading on things? So for example, on the website, we have a paper on scope 2 emissions. And what we discuss in that paper is a sort of a very precise discussion of what location versus market-based transactions are doing. And what we argue in that paper is that market-based transactions are not actually changing emissions. They're just reallocating emissions. Now to the second question.
Pricing, how do you determine the price and incentives?
Yeah, so we're without a compliance about global
Yeah.
compliance. So let's go to the third question and say that the reason that ties into this scope 2 paper is that you're dealing with non-existent budget constraints. There isn't really a global carbon budget. And so what we're trying to do is align something that can work in practice in the total absence of a global climate budget. So if under the way we have described net zero, I can be net zero even though no one else cares. I can choose to do that. I can impose that on myself. And it's very clear. I've solved, my part of this responsibility. The challenge is when we start playing around with avoided emissions and transacting in avoided emissions, I can start to say, I've solved my problem when I haven't really. So there was a recent paper that was published that was trying to make an argument about this avoided emissions versus
Be quick on this one.
removals. And the problem is, let's suppose Alicia has a business that emits 100 tons of carbon. I have a business that emits 100 tons of carbon. Alicia pays me to avoid my emissions. So I reduce my emissions by 100 tons. Alicia now claims she has no emissions because she paid me to reduce my emissions and she wants credit for it. So Alicia now, under that scheme, as a net zero company, I have an actual net zero company. Now let's suppose Abby's the Wall Street shark who comes along and merges our two companies. What happens when our two companies merge? Alicia had a net zero company. I had a net zero company. When you merge them, you don't have a net zero company. That's bad accounting. And that's why we can't allow trading avoidances.
Before we batch again, I want to come back to the pricing question and give you more of an answer there too. The price in the elegance of this asset liability matching model we're talking about, or carbon accounting for climate action, is that you have a price signal based on the duration. So if you're going to do it according to science, where you recognize that the emissions depending on the gas, 500,000 year duration, that the only way to permanently defease that liability would be to purchase permanent removal, sucking CO2 out of the atmosphere and storing it into rock for 1,000 years, $500, $700 a ton. There's your price to so that you can net that emission. That then gives you an incentive to spend $499 a ton decarbonizing your supply chain so you don't own that liability in the first place, and gives a price signal on removals. That's very expensive and unlikely in the near term, but now you have a framework and you can play with duration. So if you squint and put on rose-colored glasses, you could say some of the most leading corporates are carbon solvent for a year. They've done an inventory, they've purchased offsets removals for a year. And that's trading at, $10 a ton or whatever the number is. The inventories are wrong and the assets aren't quite right, but you get the idea. So you could imagine a world starting voluntary and moving to compliance, or through governments and procurement, or through participation, as a gating factor for participation in things, that you have to be carbon solvent for 30 years or 50 years. And there's your price signal as you move along. Another round quickly, 1, 2, 3, and then we'll ask and answer in 2 minutes. Go.
So if you force companies to choose between paying for offsets or likely incurring increased costs due to new technologies to avoid those emissions in the first place, those costs will likely get pushed off to the consumer. So how do you avoid furthering inequity in our society?
Great question. 2 more.
Yeah, thank you for being here and for talking to us about this great topic. I had a somewhat niche question about 24/7 carbon-free energy versus emissionality, and what your all's thoughts are on which of those is going to actually make a bigger impact.
In the interest of time, I'm going to point you to our What is Scope 2 Good For paper, because that's exactly what it's about. And it's hot off the press on our website. There's one more. Yeah.
I was wondering what the benefit of forcing companies to immediately sequester the emissions using technology that's extremely expensive is, over maybe just a carbon tax, which could be invested in technologies that help decarbonize the industry to begin with, which might be more helpful in the long run, maybe easier to enforce.
Okay. Two big nuts we're gonna crack in 1 minute.
I mean, the short answer is
Oh,
that.
sorry, I was pointing to you on the first question, actually. Was how do we not, if, once we start,
How did the
climate change is gonna be expensive, how do we, solving it, how do we not pass that on to the consumer?
Depending on,
Have it be repressive.
depending on the policy, we have seen, speaking of carbon taxes, we've seen examples of carbon tax policy designs like in British Columbia, where you actually set up a system where you can kind of offset those. But I think your question is bigger than that. And a lot of on the technology change side and pushing companies to adopt things that are gonna be more expensive, you know, that's a huge problem. The other piece of it is that you can just push prices down further, your value chain, right? But the other piece is that we have a lot of public money going into trying to subsidize and make these changes palatable for companies. And that looks very different depending on what country you're in. If you look at how Norway has been managing transition with CCUS versus the US, it looks very, very different. And there's a reason why Norway is further along in that story than we are, and why they have sort of better regulations in place to and oversight to make sure it goes according to how they're envisioning it. There's just a ton of public money. There's a whole different set of public-private relationships that can help steer that so that it's not exacerbating the burden on consumers. So that's just one answer to a big.
I know we're over time. I invite you all to continue this conversation with us over email and copies and conversation to put 20 seconds on.
Can't say anything in 20 seconds. Okay.
To the last question, carbon
The
tax.
carbon
Yeah.
tax question. Carbon tax is reasonably politically infeasible, certainly in this country, in the near term. The whole goal of, or one of the important goals of our approach was something that would be consistent with the economic incentives of a carbon tax, but it could be done voluntarily. So as much as, you know, we would love to wave our, you know, fiat wand through Congress, and the goal of emissions liability management, that's at the core of it, is to say this works on a voluntary basis, works much better if it's mandatory, but it will work.